Okay. So first things we want to start out with, we've got two topics we want to go through first. One of them being just like our overall, we're going to start with just our corporate strategy of what we're trying to do. So we have two different types of ways we look at investments. We're either doing something where we're buying some kind of problem, turning it around, stabilizing it, getting to a point where it produces cash flow, and then we try and sell the deal at a multiple of that cash flow. That is like our core go-to business strategy. We're trying to take something that doesn't work, make it work, and then we're always looking to essentially exit that deal. Occasionally, we can do that through refinancing the proceeds out, or we're going to actually take it fully to market and exit that deal, and then comes into play the 1031, and we try and go repeat that process and do it again. We've done that same business case across many different assets, whether that's apartments or mobile homes, the commercial space, the flex stuff we're doing. The game plan is really the same on all those deals. And now that part of this though shifted about 6 years ago when we started doing deals with Andrew, and we started getting these retail deals that are very much focused on current cash flow, right, stability, and also the debt side.
And also
some debt this year.
Also some value creation on the retail deals that as that lease renews, it compresses the multiple, or I guess expands the multiple that people are willing to pay on it, or compresses the cap rate. So people are willing to pay more for a longer term lease.
Well, usually you think about real estate as, a piece of land and a building, but with retail, the valuation is beyond the piece of land and the building too. The valuation is actually in the lease too, which is I think what you're referring to.
Mm-hmm.
And that's very important because the longer the lease, the more the property's worth.
Right. And the more stable that tenant is, and if that tenant's going through hard times or better times, right now, if you look at like a Dutch Brothers, right? They're one of the hottest retail expansion brands in the country. They're opening one up in Johns Creek, the first one in Georgia. And those are selling at barely 5 cap rates. When you look at other brands that are, we looked at Buffalo Wild Wings for a while, and those were selling at 9-10 cap rates. And frankly, they weren't even selling. They were hard to transact because the brand was going through consolidation, and that lease wasn't very reliable for future cash flows.
And that, right, because the credit behind the lease is also very important too. So like a publicly traded company is going to have a different credit rating than the 5-unit operator of whatever.
Yeah. But that whole business strategy is based on current cash flow.
Correct.
Right.
We're looking for the best bang for the buck current cash flow scenario we can get into. That's when we talk about the retail stuff. We're talking about placer data. Like we want to see good foot traffic. We want to see a higher cap rate. We're trying to find things that are mispriced where we can get a good deal and get the highest current yield. When we look at the other segments, the value add segments, we're looking for the worst numbers. We want to see that no one's going to that building because it's vacant. Hopefully that can drive down the price. We can buy it, turn it around, and then exit it. So all those turnaround projects need a good starting point, and they need an exit market to exist in. Same thing with the retail side. On retail, most of the time we're like, if we have good cash flow, we can just look at holding this thing indefinitely. When we do get a lease renewal, or there is an event on paper that happens, we're always going to say, okay, should we refinance this? Should we sell it and realize if there are gains at that time, or is there a better place we can put the funds? So those two business strategies, they have very different things. It's like what's going well, or where are the challenges we face, or what are we looking at? But they have very different business plans on how they're executed.
And they're very different reliability on distributions, right? The retail segment or the debt segment of our business has very reliable distributions that we pay out quarterly, and we very rarely miss a beat doing dozens of deals. On the other part of our segment, the value add segment, it usually takes us 1.5 to 2.5 years to get to a point it's cash flowing. And then sometimes we can have some hiccups in the middle of that. And also, even once we're cash flowing, we could have a tenant that doesn't renew and we have to turn them over. For example, the deal this future deal that we're looking at, we're about to go under contract on, it's fully occupied, but it has a couple leases that are way under market that we have to turn out these tenants. So we're actually going to go backwards before we go forwards on this property. And we do that a lot on the value add deals.
But that's the game plan on those kind of deals. So the deals have different strategies that we're looking at on each one of them. And distributions are not necessarily preferred returns are not necessarily like, how did all the cash flow of everything work out? So we're looking at different factors as that go in. We need to have enough reserves to make distributions. We need to have enough net income to create reserves. But if it's value add, it could be negative to start with. A lot of times it is, and that's normally the plan. So, okay, so just wanted to touch base on those types of the scenarios that we're going into when we look at our quarter. When we look at the overall performance this quarter, all of the retail deals essentially paying out, making distributions, doing the thing. Same thing with the debt, making a lot of times monthly distributions in that segment. And on the CapEx side, projects that went out that we're working on, we're really wrapping up most of the CapEx work we're doing.
Yeah, I mean, really the main big one that's open, we bought last August. That's the hub in Milton. You know, that one's really kind of just getting started. We're 6 months into that deal, and where permits are finally coming to life. But for the most part, all the other projects are really on the tail end of being renovated and being leased.
Yeah, the last big construction we did was in the Forum project, which is now fully leased up. So we've kind of done with that stuff. We're still doing TI work there with people, but working through all that. So it comes to the hub. The hub is our next really big renovation project that will start. We just picked up the permits. So we're getting started there. So moving on from that, one of the other topics we get questions on and we see stuff on too is like, what is the impact of tariffs in our business and how is it going to affect everything? And it's certainly a wildly swinging topic right now. And there's almost like every business has some viewpoint of how does it affect them. I think there's ways you can find that are positive, ways that you can find are negative. Across the board.
It's all about predictability to me. And all of a sudden, a lot of the predictability around pricing has not necessarily been consistent. So how do you actually estimate the cost of a construction project? Construction projects actually do have a lot of imports. It depends on what they're doing, but especially electronics. And where you're bringing up your I'm
just bringing up questions.
Oh, okay. But there was a Dave and I, we went through a whole our DG Eaton deal, DG Market, and we looked at what's made in China and what's not. And, you know, everything you can imagine, most everything manufactured, textiles or whatever at Target or DG or Walmart, if it's got plastic in it, more than likely it's made in China. But what we did figure out, and you sort of know this, but you don't really, it's not really obvious, but you know what the number one product in all of these grocery stores that's made in America is? It's food. All the food is from America. So all the food is going to be sourced locally. But I know that now we're a big exporter of I believe meat and pork, aren't we? Yeah. So
yeah, the other discussion we were having around tariffs was if you look at kind of the just-in-time shipping and really the companies that Temu was kind of the glaring example that they have to constantly importing from China. So there is very little storage. There's very little delay in getting materials from China. So whatever happens with tariffs, they're going to get hit right away with it versus a company like Dollar General or Walmart that has tons of storage. They've already paid their tariffs. They paid the past tariffs. So looking forward, they have a lot of storage. They're in a really good position to weather a little bit of a storm here that they'll actually outperform they use Temu and Shein as kind of being the losers, and Dollar General, Walmart, and Amazon because they have so much on premise or in U.S. storage that they've already paid their tariffs. So they're kind of already in position.
But I mean, tariffs as a whole, though, no, I don't think we have any businesses out there that are just going to say, okay, hey, now we're just going to fold up and die. I think all businesses are going to try and figure something out, and whether they move where their distribution or shipping or manufacturing or some of these things are going to happen. I mean, in some sense, they're all going to happen. But more looking at tariffs from the standpoint of the administration is going out and making statements and pushing things to happen, and everyone is reacting to that. So a lot of that indecision, uncertainty, they all tie together.
Right. And markets like predictability, and when the predictability is not there, the markets behave.
Yeah. It's hard to make a 5-10 year investment if you don't know what's going to happen in the next 30 days.
Right. And I think there's also people looking for opportunities too, because the uncertainty also creates opportunity. And then, in 1 year, you and I, the three of us are going to sit here and say, should have bought that. because there's an opportunity right now that may or may not be realized because of the uncertainty, like the stock market. The stock market's going down. It has bad days, good days, and do you pick that really, really bad day and buy, or do you trust, not trust the market and not buy? But like you could buy at the very bottom of the market, and in a year you could have a crazy return because you bought at the bottom, but then overall the year in the market might have not been that great.
Yeah.
Right. And so your point on kind of the tariffs kind of stagnating business and decision, we're really seeing that throughout the real estate market from multifamily to commercial and even retail, is that the transaction volume remains depressed, down about 80% off its peak in 2022. And we're not really seeing any loosening of that. If anything, we're seeing tightening of that because of this new administration, some of the lack of clarity of going forward. Yeah. So we're when we're looking to buy, there's not a whole lot of transactions happening. When we're looking to sell, there's not a whole lot of buyers out there. It's just kind of sideways.
A whole lot, there are none.
Yeah, there's none. Yeah, we pulled that CoStar report.
We had about 8 deals in this first quarter that we were looking to transact on, and essentially every single person on the buy side pulled out. So there were no, not that there were some, there was nothing. The transaction market was completely dry on all segments. Other than we were able to buy some retail. We sold
one retail and we're buying another. Yes.
So we were able to get some traction there, but overall, from apartments to office, commercial, flex, medical, all this stuff, everything was tied up, and there was nothing that was able to transact. So our biggest impact we see from tariffs is that it basically shut down the decision-making process, because people, rightfully so, are worried about stuff or thinking about stuff or haven't played out their full game theory of how it's going to work, and therefore did not make any decisions on the transaction front. And until I think we have any kind of stability or known pieces on on what's ultimately going to happen with tariffs, that's probably going to keep the transaction market ultra lean going forwards. So we do not expect to see anything pick up in the second quarter because there's been no decisions on how this stuff plays out. If we look a year back, we were talking about this summer, how everything was like, oh, we'll wait till the election. And then we got to the election, it was like, oh, we'll wait till the administration changes. The administration started doing everything they were talking about, and now there's still more indecision. So we're going into almost a year of really, really lean transaction times, and some of it's the least amount of transactions that we've seen in a market that we're working in like 10 years. So the overall outcome, tariff-wise, is more just lack of transaction. That's the biggest immediate thing we're seeing.
So where we're spending a lot of our time right now is really optimizing and leasing up the buildings that we have and maximizing them for future potential. I mean, we can go from like the Grove in South Carolina, our property, is that we took that property out to market, listed it. We're hoping to get a certain price, came short of that, and said, you know what, we're better off just keep raising rents and keep realizing better revenues, controlling our expenses. And we had a profitable first quarter, and we were hoping, we're aiming for just more profitability as we go forward. Expanding NOI.
We came in about 10%, 15% shy of targets we were aiming for on it, and therefore, we're not going to do,
And then on the commercial buildings like Forum and several others, the leasing activity is very, very busy, especially in that 3,000 to 5,000 square foot range. So the more we can focus on kind of renovating, getting our units ready. I mean, even at the Lupton, once we started building out individual suites, we started leasing. So the Lupton, we're seeing actually a lot of really good activity. So that, on our commercial assets, we're seeing, you'll hear a lot of positivity from us on our commercial assets because of the amount of expansion we're seeing in revenue, even though it's not necessarily resulting in immediate distributions. We're seeing tremendous revenue growth that's helping us build the balance sheet and build the performance of the property.
Yeah. So that stuff's been positive, but we have not seen a lot of big leases. Quite frankly, we don't have a lot of big leases to start with, or big square footage suites to lease, but that's something where we have not seen a lot of transaction.
Like what Pleasantdale would have, like 10,000
Dawson,
square
we've got
feet.
50,000.
Right. Okay.
But we just don't have a lot of suites that are over 20,000 square feet because our game plan has been to divide those up. Right. So we don't have a lot of those left. But we've got 16,000 type stuff. We've got 20,000 at Pleasantdale. Those ones we have not seen a lot of traction on, but that bigger 20,000 square foot tenant is vastly different than a like 3,000 to 7,000 square foot service oriented tenant that's going to, going to be functioning normally. Doesn't really matter what the tariff situation is. If, it's 85 degrees in Georgia and your AC goes out, you're still probably going to fix it. Right. You're going to be unhappy with what the pricing of it is and the timeline for materials and sure, all that stuff, but you're still probably going to replace your AC or at least have it repaired in some sense. Like, that's still going to happen, but you might not be buying whatever, random thing it was on Temu for $10. That might not happen. So, okay. So that's kind of our overview. Looking at tariffs, it's more right now we've seen shutdown or just like completely stalling of the transaction market. We look at deals that we're trying to exit. That definitely makes that more challenging, right? If there's no transactions, you can't exit a deal. And we do have a handful of deals, residential side, medical side right now that we are looking to exit. Okay, so let's go into, we had a good amount of questions that just came in over the course of our end of quarter on the 20th, everything that went out there until now. And again, on the bottom right-hand side, we have there's like the 9 little dots there. If you click on that, it'll take you to the Q&A section and you can put in any questions you have there and we'll answer those as well. So first couple questions, we're going to try and go through some of the residential stuff that happened first, but there's questions on Park Hill and, it mentioned, first quarter distributions went out. Everything was good there, but what do you see the distributions look like going forwards? And what are your expectations with this property? And this is one of our residential deals that we have fixed rate debt on. So we have great debt. And we're seeing that we have good occupancy. We're seeing revenue growth. So we expect that trend to continue in this market. If we look at Gainesville as a whole, we have 2 things that are really happening. You look at large employment centers, and are they going to, again, I don't think they're making any like immediate decisions, but Gainesville has predominantly been like a manufacturing and food processing area in Georgia. It's one of the largest chicken producer places in the country. So there's a lot of that happening there. And then there's also the immigration component, which is we have not seen any issues with that as of yet, but that's something that we are keeping an eye on. Over the years, we've shifted. I mean, going through a whole application to get an apartment process now, there's for better or worse, I mean, the online component of how that all is done and going through background checks and getting renter's insurance, all the ID requirements, that stuff is very like just baked into the overall process right now. So you probably see a lot more of those situations when there's like just like a paper leasing process where you're not really checking things. So we don't see that we have a huge exposure or a huge risk there. But it will be interesting just from a purely manufacturing and like production workforce base that's up in Gainesville to see how that city does. And that's where we also have a lot of our mobile home communities that are up there as well. So if that does come back, that's probably more of a place that those businesses would look to be. See how that goes.
You mentioned positive. You mentioned our residential portfolio, with long-term fixed rate debt. Really, all of our residential properties have long-term fixed rate debt. I think the shortest term is, we have Amberwood coming up at the end of this year, and the next one is a couple of years out. Yeah. So, I think
most of the stuff is like 2028 to 2030.
Right.
That we have these timelines for. So, it's out there quite a bit.
Mm-hmm.
Right. Okay, so we want to talk about other residential ones. Barnes is the other real residential one that we take a look at. This is a mobile home community that we're looking at turning into townhomes.
Yeah, so we worked a lot last year on getting it rezoned, worked with Hall County, took a couple tries, but we got there. We got it rezoned for 38 townhomes and duplexes. After the success of that, then we went out to market and say, okay, let's find a GC. And 38 is really a tricky number because it's a bit too big for your home contractor, right? But way too small for a multifamily developer. So it's been tricky to find a developer that can take this all the way through. So we're on the final rounds of interviewing, and we feel like we found the right contractor here to kind of finalize the quotes, get us basically a presentation we put together for our lender and for investors and review that. But we do believe that the site is viable to rebuild on, and it's been zoned that way. So we're just working on getting it started.
So it's going to be a little bit of time before we get through and figure all that. Well, not figure it all out. We know what we want to do, but get all the pieces in place so we can do it. But that's definitely in the works. So there'll be more with Barnes as we go through that process. If we look at the rest of our residential segment, we had a great quarter overall. We don't have any other specific residential side questions that came through, but we saw revenue growth when the market saw negative rent growth, and we saw our margins continue to improve on the residential side, which has been very positive. But it's also the standpoint that when we have deals where we cannot control our margins or losing our margins, we've exited those deals.
Right. A lot of residential, I give really good credit to our team. Our team has been, well operating and put together for the better over 10 years now. I was talking to Stephanie this morning, who runs our residential division, and I was recommending a new plumber to her. She's like, Josh, we haven't hired a plumber in over 6 months. We do all that in-house now. We have the capacity, we have the know-how, we have the ability to do it. So we don't hire trades as often as we used to.
Yeah.
It's fantastic.
And that's really an effort to control how we are performing. One, we get to make sure it's done correctly and consistently with the right parts. We can control the messaging to our residents, and then we can control the cost. All three of those things help with overall margin on the investment side, but also just makes us have a happier resident that understands what's going on, and we can give them a clear answer, a clear timeline on everything. Okay, so we can jump into some of the commercial ones. I had a question that came in just on Johnson Square and what is our timing of the asset going to be? And that's a deal where we have, we bought that one. That's a good story in the commercial side at 68% occupancy. We have fully leased it up. Can't really get any more occupancy out of it. We're continuing to see renewals and rental rate increases, so it's in good shape. But then it's like, okay, we're coming up to the point that crazily 5 years will be here before we know it on that deal. And what would we like to do? Either refinance it or sell it. We have spoken with brokers there about taking this deal out, listing it, seeing what kind of offers we can get in place. That really gets us to our, what's the best market value of this asset. We always have in our quarterly reports what we think our market value is based on NOI and based on current cap rates. Now, like we mentioned in the first quarter, with very minimal transaction volume, there's not a lot to base that on because nothing really transacted. So, but this one would be one of our, it was one of our early commercial deals, but it would be a good indicator for how the whole game plan is going on the commercial side of buying a deal, turning around, investing the capital, and seeing what we can get on either the exit price or the full refinance. So, timeline on a decision, we're actively in the middle of solving both of those pieces of the puzzle right now. We do not have any offers on it. Still going through that process. We haven't done like here's a final call for offers, bring everything together. Typically, our process is going through the deal with a broker. We're going to spend a couple weeks doing that. They're going to go out, talk to their contact list and have tours and go through. And then eventually we're going to get to okay, let's collect offers and let's come to a finest and highest and best offer. We're not even into that timeline yet, though. So, but we have started that process and working through it. So, if we spend another month or two doing that, we'll have pretty clear direction here by the end of the second quarter of what that looks like.
And the good news on Johnson Square is, our largest tenant there is an autism school, ADE school, and or MDE school, and they keep wanting to expand.
ADEs are 1031 exchange.
Yeah, exactly. And the MDA school keeps wanting to expand, and they keep asking us to hold more space for them. Every time a lease comes up for renewal, they ask, well, can we take the spot instead of renewing the existing tenant? So it's a constant expansion discussion with them, which is great.
Yeah, that's good. Yeah. All right, so I want to jump onto some of the medical questions that we have, and a lot of these, on the medical side of the business, it's a very well represented area. So you're mostly dealing with brokers that either represent a national type tenant, or you're working with like a staff and an attorney that's based at a practice. So the one thing we have coming up is a lease with Duke Medical. That's we call the building Duke. It's our 95th deal that we did, and they have a space with us. And in their lease, it basically says they have to inform us if they want to renew. So that's the only thing. They don't have to tell us if they don't want to renew, right? They don't necessarily have to do anything other than tell us they're going to renew what they want to do. So we've sent them renewal offers. We do not have a clear answer as to what they want to do. We've heard that they potentially want to consolidate all of their real estate, but again, they don't have to tell us anything, and we haven't gotten a good answer from them on what it would be. So,
and frankly, this is not the first time this has come up, that a larger tenant comes to us and says that they want to, they want to look at other spaces, and then they can't find any other spaces. So, for example, at Midtown, the IRS came to us and said that they don't want to renew, and they're going to look for alternative places. And by the time that their lease came up for renewal, they realized they had no other place to go, and so they had to renew with us. Otherwise, they wouldn't have a home. So, speaking of Midtown, we just sold off another building at Midtown, and that was our 4th successful exit there. And so we bought 14 buildings at an average price of about $75 a square foot, and we're exiting in kind of the low 100s a square foot as we stabilize each building. We've sold now 4 of them, so we have 10 left. And Wells Fargo hasn't been the best lending partner. They didn't give us any of our draw money, and they're not giving us any of our proceeds when we sell. So we're using 100% of the proceeds to basically pay down the loan. So starting with an initial loan of about $15.5 million, we're now down below $8 million. And so we sell off, we have one big building. If we sell that off, it'll pay off the whole loan, or we sell off 2 more small ones, it will pay off the whole loan.
Yeah.
And then we can basically reassess our property at that point, because we'll still have, give or take, 7-8 buildings.
we have just over 200,000 square feet right now.
Yeah.
The one main asset we could sell is a City of Chattanooga building that they're in there. It also has one 10,000 square foot vacancy, which we fully white box. We've turned that thing again. It's one of our bigger spots though that we haven't leased. So we could sell that deal and exit it, and at 145 a square foot, we pay off all the loan balance that we have remaining. Now, that might not be the one that we get the most traction on as we're looking to exit deals at Midtown. We're basically taking like, what deal do we have that fits with what's trading in the market right now? And then let's take that one out.
Yeah, we're seeing the most activity in these kind of smaller $2 to $3 million personal buyer, personal portfolio buyers. That someone's buying it for their own ownership instead of a group of investors or a real estate company.
Yeah. And that's really the transaction volume that did happen in the first quarter, was all that kind of stuff.
Yeah, sub
30,000 square feet, cheaper buildings that were owner occupied or owner bought, direct owner bought.
Right.
So, but Midtown, overall, we're optimistic. We're gonna keep going down this path. This has been almost 2 years where we've been selling off buildings one at a time, generating good returns, and then paying down the loan. So we think about that overall, like, yes, there have not been distributions there. We're making good returns on the buildings, paying off the debt, and we will realize that gain once we get through this process. If we sell the City of Chattanooga, the biggest one we have there, we'd fully pay off the loan and have 160,000 square feet left-ish. Or we'll sell off one of the other small ones first before that.
Right.
So, but a lot of things would have to change in the second quarter to start having a like $5+ million transaction happening
Right.
there. That's where that stuff's all been really tight. So
yeah, so we'll probably look at selling off the smaller buildings while letting the broker know that he could sell off the larger ones, but realistically, it'll probably be the smaller ones.
Yeah. So, okay, one of the other deals we have that we're working through is Top Notch Flex, and this is a deal that we purchased. We're always very excited about buying deals that have really low rents, and the reason is because the market rents are typically significantly higher. So Top Notch, we bought all of our buildings there, and some of the tenants had $3 and $4 a square foot rents, whereas the market's over 10. And we pretty aggressively go through in those situations. We say, look, it's a hard conversation, but the market is 10 plus and we're at 3. So there's got to be either some movement, but we can't re-sign a lease at $4.50. That just wouldn't make economic sense. And that person would then have to leave. We've seen this at other assets we own. Pleasantdale, Flex here in Atlanta, Davis Circle. These are deals where we had tenants that were paying, one of them was paying $1.50 in a square foot in rent. Market's $10, $12. And that doesn't work. At Top Notch Flex, more than we would have liked, have said, look, 3 to 4 is the max that they can do, and they're going to vacate. With Top Notch and how it's performing.
The good news about Top Notch, though, is that the suites are built out, very purpose-built. Most of them are 1,200 to 3,000 square feet. They have an office. They have bathrooms and conference room and a roll-up door on the back. So the cleanup or turnover cost is pretty minimal. A little bit of paint, a little bit of flooring, but we should be able to get someone in there pretty quickly. It just takes that turn time, the downtime of the person exiting, and the uptime. Once you sign a lease, you usually get like 1 to 3 months of free rent, depending on how long of a lease you sign. So the uptime to kind of realize that revenue is probably a full like 6 months to kind of be down.
That's a lot of the revenue growth we also saw on the commercial side this quarter came from leases that were signed in 2024, where that stuff had burned off and now they're paying. It takes a lot of commercial side. There's always some component of leasing right now has concessions, which basically means they're getting free rent. Right. On their move in.
So speaking on the commercial side of the business, let's talk about the station for a minute, because I think it's pretty big news in the commercial division, but also in the QOZ. We have 5 assets left in the QOZ, 2 apartment deals, 3 commercial deals. The ones that have been very challenging have been the Lupton, which is the 6-story office building in Chattanooga. That is finally getting some leasing traction, but it just takes time to kind of realize the revenue. So we're give or take 15-20% leased over there now. And we're doing tons of showings. The activity, the leasing report and the leasing activity is actually very, very positive there. And then we have the station, which was our corporate office for a lot of years, and it's been a great property. It's held at 80-85% occupancy, but over the last year, you've been more heavily involved than I have, but we've made a friend with our neighbor.
Yeah, we've got just over 10 acres. Our neighbor has 8 acres, so it's roughly combined. We're like 10.6, a little over. So we got like 19 acres of space that we're going to look to submit those plans to the city of Norcross and have it rezoned. And right now that plan would enable a whole retail frontage to be built on the main part of the property, townhomes, apartments, a parking deck. So it'd be a very, very significant project that we'd be able to take this deal. When we bought the station, was definitely the idea of kind of a covered land play as we got there. And now we have this, we're going to go through the zoning and submit this project with the architects to see, like, will this be approved and does this work? We're pretty optimistic it will. And then we would have the situation, an opportunity to roll into that project. And that would basically see us through for the next 5 years of the QOZ. Rough terms, it's probably a $120 to $140 million project that we'd be rolling into as one of the partners in it. Obviously, we're not doing that full capital stack with the current QOZ fund, but it is a great opportunity for this deal really to realize some significant long-term opportunity in value gain.
Yeah, if you haven't been to it, it's right at the entrance of downtown Norcross, or historic downtown Norcross, and we have the corner of the intersection of Atlantic and Holcomb Bridge, which they need to put around. The city needs access to that for the roundabout and kind of this new entrance to their downtown city. So we are sitting in that parcel that allows all that to happen. So that's why we're kind of a critical point with this partner that wants to redevelop it.
Yeah. I just want to go through some retail stuff.
Sure.
Some other questions on retail. So retail side, retail is one part where we were able to actually have transactions in the first quarter, and we're lining, more on the sales side too for this quarter that we're working on.
For the past 4 months, I believe we've purchased 3 retail locations. We managed to sell one, made some money. And we're also looking at buying one right now. We have something under contract right now. I'd call it opportunistic. So uncertainty creates opportunities. And I believe this is one opportunity that uncertainty has created. We're buying a retail asset, a market like a grocery for an 8.3 cap, which is absolutely unheard of. And we haven't done it my whole entire time here at Greenleaf. We haven't seen cap rates in the 8s until like the end of last year. So
And your point earlier about kind of tariff protections being around, food is a pretty safe harbor because a lot of our food is, domestically produced or domestically put together. Is that?
And I think of all the things we need every day, we need food.
Yeah.
And we need food in rural markets too. And so
Right.
these markets that don't have a lot of, they don't have the Kroger or the Publix or the whatever, they don't have grocery stores. And that means they usually have to drive 30 minutes to a Walmart or someplace. And if they only have to drive 10 or 15 minutes to a small footprint grocer, it's much more preferred.
I mean, the size of these deals though too is at a couple $1 million on the retail side. It's still something that's transacting. You can still have an individual person buy something.
Right.
That's still there. So there's still some transaction volume. It was not as tight as the overall, I would say the overall real estate transaction market.
And we're getting cheap debt, not cheap debt, cheaper debt than the marketplace is showing, because they're for the quality assets, for things that are publicly traded, have some certainty, have some desirability. I mean, you could still get those rates in the 6s, which makes it work. So when you're buying a deal with an 8 cap and you're getting financing in the 6s, you have that spread that you actually make money.
Yeah. And this quarter we started using a platform called Lev, which is a call it like a
debt sourcing platform.
Match.com for banks and in prospective deals.
Bank dating service, a bank dating service.
Yeah. So this
More
Lev
like
group.
Tinder, or are we swiping?
No, I don't
or-
think there's any swiping.
Yeah,
I think
okay.
it's just a group out of New York that's put together just a network of bank lenders, so we can post our deal up there and see what interest the banks have. So we've had dozens of calls with new banking opportunities, which is exciting as well, and seeing what do they think of these opportunities. The banking world in Atlanta just keeps getting consolidated, where there's just more and more. We used to have a lot of banks, and now it's turned into like 3 banks in Atlanta that have kind of all merged together, right? So this opportunity for us with this Lev platform that we can go out and get introduced to just some more banks on a national level and see if they're interested. And they especially work if it is a national tenant. If it's not a national tenant, typically we're working with a local bank that understands, just that tenant in our area or the area that the bank's in, right? But at the national level, we can look at national bank lending platforms, which is different, but it's also a benefit of retail and probably a big part of the reason why retail transactions have actually remained, because we are looking at it from like a national type of market versus if we're selling a local flex building, it's more of a local buyer.
Right. And we're not selling widgets. We're not doing any leasing. The lease is in place. The lease has a value. It's predictable. We know the cash flow day one. And especially when the deals are triple net deals like this one we have on the market right now, when it's a triple net deal, you could literally predict the next 5 years of operating history for this property with literally almost no variance.
Yeah. Right. And the difference between double net and triple net is on a double net, we would still cover, say, roof and parking lot. And if there's a roof leak, we're on the hook.
Yeah. We got
for replacing that or fixing or replacing it. Or if there's a pothole in the parking lot, we have to go out there and fix it, versus a true triple net. That's all on the tenant.
We do nothing.
Yeah. We have to inspect it. If we find something wrong with the property, we tell the tenant they have so many days to fix it, or we can terminate their lease.
Right.
Not that we're looking to do that, more just from the
we
standpoint that we do want them to take care of the property.
Yeah. In fact, for all of our triple net properties, all we're literally doing is paying the mortgage and making sure the tenant's complying with their lease. And so like tomorrow I get to go eat at one of our Applebee's and go say, hey, I get to go walk on the roof tomorrow and see how
check it all out. But every retail deal, we got to go inspect it on an annual basis and see how everything's doing. We visit these things frequently, so we know how they're performing and are they clean. You can walk into any retail establishment, you can understand if things being well taken care of and operated or not, right? So that's something that's hard to do remotely. You got to go and just check it out. But that's a lot of our kind of driving and making sure every one of these things is working and performing well. So when we look at like the sale and transaction side on retail, I mean, we're still going to, occasionally tenants will reach out to us about, do they want to try and do something with their lease early? A lot of times it's us reaching out to them when we're like, okay, 18 months out, 24 months out, do we want to start working on this? We're not waiting until there's like 3 months left. It's really 12 to 24 months out that we're working on a lot of these renewals. So,
Right.
If we do get a yes, then we're going to really, no matter what the market looks like at the time, we're going to take that out and say, is there a better debt option, or is there a way we could sell this deal to realize some of those gains, or should we just hold it? We're going to do that math every time. So if you're in one of them and you see like, hey, why are they sending this? We didn't think we're doing anything here. We didn't think we were selling this. Like, we're always going to go through the math and see what the best option is at that time.
I mean, the Applebee Seneca we took out probably a little bit over a year ago, didn't get the number we were hoping to get, and decided to just kind of keep it as a pocket listing for the better part of a year. And we finally got the number we wanted. And so we decided to exit.
Pull the trigger.
Yep.
Yes. We made a good return, and we're trading into something different and something that'll have a better return. And so, I mean, that's the plan. You just keep on, hopefully you're trading up with every single deal.
Compounding. Yep.
Compounding. Yep.
Cool. Huh. Well, we went through all the questions that we have that came through. So again, if you do have a question on a specific deal that we want to touch base on, those 9 little dots on the bottom right there, it says meeting tools. You can go to Q&A and you can type in any other question you have there. For now, that kind of covers all the questions that we do have, though.
Yeah, well, let's talk about over the next we're about to put another property in Chattanooga under contract. It's an industrial flex deal. The major tenant is Volkswagen. We're pretty excited about it. Again, going back to these tariffs, one of the opinions we read on tariffs is that
there are lots of opinions.
Yeah,
yes.
There's no shortage of opinions, but one of the opinions is that the industrial storage warehouse flex market could really boom because of the acceleration of bringing goods here to beat the tariffs, especially in the short term. So this property is 92% occupied. We're buying around $100 a square foot, pretty high cap rate. We're pretty excited about it, and it's full. Has a couple of tenants paying below market rents, so we can get aggressive with those tenants because there's good demand. There's very little supply of this type of product in Chattanooga. Also, it kind of has an out parcel that with a little bit of retail in it, and one of the retail tenants is a bank, and they're the ones that are competing to bid on the property to be our lender, and they're also looking to expand their footprint, so they want first right of refusal on any vacant space we get. So overall, it's starting out to be a very positive deal from an occupancy standpoint, from a rent growth standpoint, in a market that has very limited supply of flex industrial space like Chattanooga.
Yeah. So one of the few things we've been able to actually get to hey, we're at the table talking, trying to get through a PSA or purchase and sale agreement to make this deal work. It's definitely been light going out there. So we're very excited about getting that one, if we can get it fully signed up. And at that point, we'll obviously share that with everyone as to the status of where we're at.
Yep.
So question here just on Pleasantdale Flex. Thanks for putting it in. So how is it going with the last space? So at Pleasantdale Flex, we had one large suite that we were left to lease. So we go through this debate of, should we divide up this space into like 3,000 or 5,000 square foot increments? And that cost is essentially putting in firewalls and putting the roll-up doors specifically for them. Or do we try and lease it as is? And Pleasantdale, we went down a LOI and lease negotiation with 2 different tenants that ate up like 7 months, and ultimately we didn't get there with them. And we were in a let's make a deal stance, but the tenant ultimately chose to do something else with it. So that's, that sucks, quite frankly. That's kind of the worst thing we want to have happen, is where we get to like the finish line and back out and have it happen again. That's we can't make distributions if we have one giant suite vacant that are there, because we're not sure how much TI are we going to put in. Like, what's this thing going to look like?
Yeah, I mean, the suite's about a third of the property.
Yeah. So that was definitely painful, and not what really our plan is on any negotiation, but ultimately that's what happened. And now we're back to it of saying like, okay, do we want to start dividing this thing up so we can get some real activity in the like 3,000 to 5,000 square foot space? So we're not going to have any distributions until we get that suite leased. That's essentially we're break even now on the asset. If we have that, then we're able to make distributions, and it's all positive. If we don't have that, then we can't make distributions. It's really, it's as simple as that from the standpoint of, if we don't have a tenant in that suite, we can't make distributions.
And we can't, the other thing we can't really do is show a 10,000 square foot suite to a 3,000 square foot user and say, hey, this could be broken up.
Yeah.
They can't get their head around it. We have to commit to spending the money to break it up, which is a significant amount of money, or we have to commit to keeping it as a larger box, which takes a lot more time to lease. So as we get I would say we've been distracted with these larger users to take it as is, which would save us lots and lots of money. And so we're hopeful that we'll find one before we commit to just pull that plug to spend all that money to break it down into 3 separate suites.
Yeah. But also with again, we talked this first quarter, we didn't really have any leads on the big suites across the portfolio. So it's like, now we've got to go down that path.
Yeah.
Well, which is later than planned to do it. But at smaller suites, we feel much more confident in leasing. That's where really a lot of our leasing demand has been.
Yeah, we had similar types of timelines or results on Dawson and Pleasantdale. These are both more true industrial buildings with larger suites that we went really, really long down the road with discussions 7, 9, 12 months, and the tenant blew out before they even signed the lease. And then we had to start from scratch again, which just honestly threw both of these deals off their timeline by about a year to 18 months.
Yeah.
That really, frankly, as we hold the deal, we won't be able to catch up the prefs on the deal. Our aspirations are to get them leased, which Dawson's now fully leased. Look at a refi or look at a sale to basically stabilize the property and rebuild the balance sheet.
But Pleasantdale specifically, to give exact answer here, is our net cash flow over the past 3 quarters was 0. So we didn't have any positive. It wasn't negative, but it was almost exactly flat over the past 3 quarters. So that puts us in the spot of like, okay, it carries. It was positive $8,767. So basically 0 on that deal. When we get this thing leased, we're going to have to divide up the suite to do that. Then we'll be able to make distributions. And hopefully our plan, leasing and dividing that space up, if we can do that by the 3rd quarter from the timeline of, we got to get permits for it, got to put in the firewalls, and we'd have to lease it. Okay.
So real quick before we wrap, we'll have, after this industrial flex deal in Chattanooga, we'll launch so we have the Dollar General in Eton that's out right now. It's Dollar General the marketplace with the fresh produce. We have the industrial flex property in Chattanooga coming up in about 3 to 4 weeks. And then after that, we'll have another package of discount notes with our partner that we've worked with in the past. This will be round 2 of that. We've been in round 1 of it for 18 months. It's performed very well. So now we're looking at doing round 2. And then at the end of May, we're doing an investor event at Grapes and Grain, where we're having one of our borrowers come and talk about our relationship together, talk about how we're doing lending together and how it's helping progress this project.
All right. Thank you very much for watching this quarter. We're gonna leave this open for a couple minutes. If you want to stick around and ask any questions, the little Q&A thing is open. We're happy to answer anything on any of the deals to the best we can here. So thanks for joining today, and appreciate your time. It's a good question. That's a very good question. I attribute it to the fancy shoes that I bought at the last marathon, and maybe a few years younger. Or Coke Zeros. It could be a combination of those.
It wasn't the Slim Jims?
I don't.
The only guy I ever know shows up to a marathon with Cheetos and a kid's fanny pack.
My
Was it
daughter's fanny
Cheetos?
pack.
It was Cheetos, right? What was it?
No, it's Fritos.
Fritos and a kid's fanny pack. Yeah.
Thanks, Robert. Thanks for putting that in there. All right, we good? All right.
Thanks.
All right. Thanks.